Welcome to a weekly look of the gold market fundamentals with David Jensen. It's really good to have you with me again, David. Thank you for joining me.
Good morning, Jay. It's my pleasure.
Always good to talk to you about the fundamentals in the gold markets. I see gold is showing some strength in the paper markets. I guess the question in your mind and mine is always, to what extent is that reliable in terms of what the real price of gold is? We have the paper markets, which you and I talk about almost every week, and then we have the real physical markets, and does seem to be a disconnect there. But I would like to go over some of the definitions that we recently spoke about that I think might be good, again, to remind ourselves of as we get ready to discuss today's topics. But so let's go over a couple of those, if you don't mind, David.
Sure.
Spot contract trading of metal, what are we talking about there?
Yeah, that's the trading of contracts for immediate metal ownership, and that trading represents 90% of the LBMA's daily trading volume. So it's a contract that you hold in the market, and notionally when you hold that contract, when you buy it, you own metal in London.
Okay, you own metal, and then you have the right to take delivery of that metal?
It depends on the contract. This is an over-the-counter contract, so each contract has its own terms. But we know that the vast majority of the trading in London is this unallocated trading that goes on, and the LBMA notes that you are just an unsecured creditor when you hold these positions. But the large majority of people believe that when they hold a spot position in London, when they hold metal in London, that they're holders of the right to the metal, and that they can take the metal at their own discretion. I think that we're seeing numbers here which indicate something very different.
Well, we want to get to that in a few minutes here, but let me just a couple of other definitions. Open interest.
Yeah, that's the total ounces or tons for the very large amounts of gold or silver, which represents the positions that are held in the market. So, that would represent the total number of claims that are in the OTC over-the-counter market there at the LBMA, which is the vast majority. It's about 80%, 85% of daily global gold trading.
Yeah, so they may or may not be deliverable in actual physical then.
That's the total ounces of spot contract positions which are in the market.
Mm-hmm. Okay. One more definition here today: net settled clearing volume.
Yeah, that is the number that the LBMA posts on a monthly basis. They post a number which represents the average daily net settled volume. Now, we touched on last week how that is a deceptive number if you take it as being the total trading. And we use the analogy, if I sell 10 units of gold to you and I buy 9 units back from you, that they would post 1 unit of net settled trading. In reality, there's 19 units of trading between us, but they post the 10 minus the 9 units, and the net of that is 1. And as a consequence, you need to adjust the numbers that they post to get a sense of the true daily trading volume, and then ultimately of what the open interest or the number of positions that are held in London are for gold and silver.
Mm-hmm. Yeah, I mean, we talked about this the other week. Recently, I guess we talked about the tremendous amount of claims, potential claims for which people think they have. It just simply isn't enough gold or silver, and silver even more of a shortage to meet those claims if the people really wanted to take delivery, right?
Yeah, that's correct.
And just to give our listeners, again, perhaps go over those numbers again.
Sure. Well, we to get those numbers of the total open interest or the claims that sit in London on the world's premier gold and silver, platinum and palladium exchange, we turn to the LBMA's own study, which is the local London liquidity survey, which was focused on Q1 2011. And what it did, then netted out, I'm using their terminology now, but the net result of their liquidity survey of their own traders was that they said that you can take 10 times the numbers that we post daily, that the LBMA posts daily, And conservatively, so the number would be even higher, but it'd be higher than 10 times. But if you use 10 times, you have a conservative estimate of the daily trading volume. And why that is really notable is that if we look at London, the LBMA's net settled volume for November of this year, of 2014, pardon me, the most recent year, is that we look at the net settled volume multiplied by 10 for gold is about 207 million ounces a day versus 90 million ounces a year of total gold mine production.
Yeah.
And if we look at silver, it's 1.7 billion ounces a day of trading in London versus about an annual global mine production of about 0.8 billion ounces. So they're both well over 2 times global annual production that is traded in that market daily. And the net of that is, of course, is that what that means for the open interest, which you and I touched on there, Jay, is that you get an enormous open position of open interest of 400 to 600 million ounces of gold and roughly 3.5 to 5 billion ounces of silver of claims that are sitting in the market for which the holders, which could be sovereign interests and investment houses and corporate, commercial interests, that are sitting in London, which is the premier gold market, saying, well, we've got our gold, we've got our position in London. And, that is not a fact that you can have that delivery when we look at the available metal that's in the market for delivery. And, I mentioned last week that there was about 1.2 billion ounces sitting on the balance sheets of central banks. And that uses just the face value of roughly 1 billion ounces for the central banks. And I put a 200 million ounce plug number in there for China because China is not very open about how much gold that they actually do hold in their central bank, but we can assume they've been buying hand over fist given the market activity. So we had 1.2 billion ounces of global available gold through these refined stockpiles, also including the ETFs, and then also about 0.9 billion ounces of silver. Versus 3.5 to 5 billion ounces of open interest. So there's just many, many multiples for silver, especially of an open position sitting in London versus what is truly available for delivery.
Yeah, well, I guess as long as people think they own the gold and they're not going to go to try to take delivery of it, the game can continue. Or say the con game can continue as long as people think they own it. And they're satisfied to continue trading in paper currency. I guess the game can go on. But you pointed out in your note to me this morning, David, that there's a gold problem. The gold stockpile that we're talking about does not really account for off-balance sheet central bank leasing of gold.
That's right.
And that's been going on for a long time. Can you talk about that a bit?
Yeah, absolutely. The 1.2 billion ounces, or if you want to use 1 billion for just the official statistics that the central banks put out, remove that plug number for China. So in round numbers, there's 1 billion ounces notionally held by the central banks. But we know that there has been off-balance sheet central bank leasing of gold going on, and some countries have exposed this accidentally. I think the Central Bank of Portugal revealed that a number of years ago, that they had the vast majority of their gold had been leased into the market. And so we don't account for these off-balance sheet transactions, which depletes the gold that is held by the central banks. And so the central banks likely hold far less because it was evident decades, more than a decade and a half ago, it was evident to market observers that there was very large amounts of gold being leased into the market. The other problem that we have right now is that the central banks are many of them are now actively buying, so they're not a source of gold to the market, but they're actually depleting the market. So that's another statistic there that is impacting the value of central banks, of the source of liquidity for the market. But the earliest information that I could find, Jay, about central bank leasing of gold is from a presentation done by Richard Pomboy. And he did a presentation in 1997 at Grant's Interest Rate Observer at their investment conference in New York. And this presentation done by Richard Pomboy was originally posted at Gold Eagle, but it's since been taken down. But using sources like the Wayback Archive service that's on the web, they catch snapshots of various web pages, and I'm going to post in the web notes, or sorry, in the discussion notes, the links to these. But Richard Pomboy in 1997 said by his estimates that there was a need for 1,500 tons or 48 million ounces of gold to be leased into the market to contain the price of gold and to meet the deficit of gold in the market. And he mentioned at the time that this was central bank leasing, which was serving as a fix, for the demand in the physical market.
Mm-hmm. Well, it wasn't only Richard Pomboy, but some names more familiar to me personally.
Yeah.
People that I've known personally, James Turk, Reg Howe, and Frank Veneroso, all came to the same conclusion, but from different directions, right?
Yeah, they all had independent studies, and I don't even think that they were aware of the work that each was doing. But in roughly 2000, 2001, yeah, James Turk, Reg Howe, and Frank Veneroso all came out with estimates of about 1,500 tons a year of gold, or 48 million ounces of gold, which were being leased into the market each year, and that this was taking the form of off-balance sheet gold transactions. And we've seen off-balance sheet transactions before, but usually in the markets with companies like Enron. So here we have the central banks or the regulators participating in these kinds of schemes to obscure what's going on to the markets, and running artificially low interest rates, which you could then do with that kind of activity.
Mm-hmm. So what we have then, we have central banks. You mentioned the Bank of Portugal that sort of somehow it came out that in fact they had leased out their gold. So what they have on their balance sheets, though, instead of really, they might report it as if it's gold still in the balance sheets of these central banks, but in fact what they have is a gold receivable rather
Right.
than the physical bullion in their banks. And now you're telling me, and we know from lots of things that we've read and discussed here on this show as well, that there are net importers of gold, most notably those countries that are somewhat adversarial to the United States, such as China and Russia. And so, 1,500 tons a year need to be sent out into the market to suppress the price of gold, which we also know had to take place if the central bankers were going to push interest rates down, and they most certainly have continued to do that into some places, sometimes with the Swiss franc, for example, negative nominal rates, but we have negative real rates almost everywhere, which is extremely bullish for gold, and yet the gold price has been subdued, I guess, by this continual leasing of gold into the markets. Perhaps we have also talked, of course, about how the paper markets subdue the impression of what the price of gold is, and to keep confidence in the system down. So all of these are, this is just another way of trying to suppress the price of gold to keep this confiscation, or let's say this low interest rate scheme in place that's been going on around the world, right?
Yeah, there's been a credit bubble that's been run for several decades now. And now we're digging through the data, and we can see that this central bank leasing of gold has been going on for decades as well. So the source of our malaise is the activity of the regulators themselves in rigging market signals. Mm-hmm. And one of the things I look at, Jay, as well, is that this open interest of, estimated at 400 to 600 million ounces of gold in the LBMA, I'm really starting to look at that and wondering about the gold there that these unsecured creditors are holding, and if that might be some central banks that are holding gold in the market, saying that, okay, well, we hold a position here, and we can still maintain this on our balance sheet as a consequence. Mm-hmm. And so I don't know what the accounting is, but it's interesting that claim is so large, versus the amount of gold which is produced every year. I mean, mm-hmm. the number's running roughly, 5 to 6, 7 times the amount of gold that's produced, that's liquidly provided to the market for mining every year. So, we'll see how this shakes out with time, but it's concerning to me, because at the center of this, we see the Bank for International Settlement and the Bank of England. The Bank of England acts as a gold market liquidity maker, providing physical gold to the LBMA when the paper market is stressed.
Mm-hmm.
And so here we have the regulators themselves captured and rigging the markets. And then, of course, this is going to end with I think a credit market, a severe credit market problem when there are physical withdrawals which cause the inevitable LBMA default from whichever party, we don't know, but someone is going to not be able to source metal at some point. And as I said last week, it may well be in the silver market because of the extreme disparity of claims versus the total above ground supply of refined metal of 0.9 billion ounces, and that there's about a 3.5 to a 5 billion ounce open interest of claims there in the silver market. So it may be silver that sets off gold, that sets the whole thing off. But we can be sure that when this fails, that there will be call for increased regulation. And I was disconcerted today to see Bill Gross saying that capitalism has failed, and Soros calling for more regulation, and Bill Gates saw yesterday he's calling for world government. So increased regulation, increased control, ceding of personal liberties, and really destruction of the function of capital markets and of capitalism, which is really just market pricing for the demand for goods and services. So that the parties that have really participated in lawbreaking, in destruction of the markets, are now calling for increased control in their hands or their affiliates' hands as a solution, a consolidation of power at the center, which I don't think we've ever seen work throughout history in terms of being a stable or a fair or just system.
No question, and the deception continues as long as they can carry it out. For example, you mentioned in your notes to me as well that there was some gold that was looted from Iraq and Libya during the wars, and recently I remember I think you and I talked about how Goldman Sachs had obtained a huge amount of gold from Ecuador. Ecuador apparently was able to borrow some currency against real money, gold, and use it, and sent the gold to Goldman Sachs. So these banks and bankers that are involved in this activity, as long as they have enough gold to keep those people satisfied who actually require or ask for delivery, then the game looks like it's real. It looks like it's just like any fractional reserve banking system, which is really illegitimate. But as long as you can keep the depositors or the people satisfied and conned into believing in the legitimacy of the system, the game can go on for a while longer. But David, you know what's happening with all of this obstruction of price discovery in the capital markets. What we're getting is a breakdown in the global economy. So I think it's just a matter of time that the real economy it breaks down, and confidence is lost in the game because the foxes have they're guarding the chicken coop of now starting to eat all the chickens, and the chickens try to fly away, and people get really frightened about what's going on, and they say, where is my gold? At some point in time, there's going to be increased demand for delivery. Don't you think so?
Yeah, I do, and I think that with policies such as quantitative easing, which we know now from experience does not work, both from Japan's experience and from North America's experience, and many people, including Mervyn King, he's now gotten religion. Now he's no longer an active central banker, warning about QE. But we know that printing money doesn't produce wealth. And we can see far enough now from experience of what their policies are, that they aren't going to work, and that they're going to lead to economic and social disruption. And then we will hear the call for increased centralized power and increased centralized control from the individuals who have participated in and been close to active law breaking as they have progressed forward. So it's very predictable, but I think there's so much information out there that I want to leave that message of hope, that there is hope, because humanity has been through many challenges in the past. The Weimar Republic, Germany went through a horrific experience there, but Germany survived and moved forward. Now, unfortunately, we had a totalitarian fascist government that took over after that crisis, but overall, humanity tends to flow and find solutions and go around problems. And I think it's just essential for our discussions, Jay, that we draw these problems out into the light and that solutions be found for these problems, and that we don't follow up on these disruptive activities by central planners with a system with more central planning and totalitarian style of enforced government from the center.
Well, I absolutely agree with that, David. No question about that. But when I hear people like Bill Gross and George Soros saying capitalism has failed, no, I think what's failed is, in fact, central planning, because the central planners have not allowed capitalism to work. Most notably, of course, we talk about zero interest rate policies and the force, and they make that possible by suppressing the price of gold. And so, as a result, of course, the middle class is being destroyed. Yeah. It doesn't, as you point out, we can't create wealth by printing money, but what does happen is there is a redistribution of wealth through the creation of money. And the people in charge are getting that 1% and that 1/10 of 1% of the top people in the world that have control of our policy makers. It's certainly, if anybody really believes that the American people have a democracy and they have some choice in who becomes president, then I have a bridge to sell them, because it just simply is not true. There's no way that anybody other than the military-industrial complex, then the really rich, powerful banking interests are not controlling our country. And I might add, David, really working towards a one-world government. And I think we talked to Jim Rickards on my radio show. Rickards is talking about the next decline, the next major implosion in the global economy. He believes, as do I, that it's inevitable. And when that happens, then his next savior is the IMF. And so what we're doing is now getting rid of sovereign nations, sovereign banks, and moving it all into a one-world government, at least in the Western world. To the extent the Russians and Chinese go along with it, I think there's going to be a lot of difficulties over that. But yes, I think you're right, David. We have to try to see what is really going on. That's our hope, is that people will start to understand that why we're having the problems we are, and then demanding changes accordingly. So,
if I can interject here, the thought is that the need for QE, for quantitative easing of creating money and buying assets from the market by central banks, the whole need for that arises because of regulatory capture of the central banks.
Sure. That
there was full and complete capture of the central planners, as always happens when you have central planning and consolidation of power. And so we had the central planners were reaching in and were rigging the gold market and rigging interest rates and blowing a global credit bubble, which is now collapsing, and QE is a knee-jerk reaction to that. So the call for more central planning and for more regulation and more centralization of power flies in the face of our experience, the experience of humanity going back millennia, and I think that's what we're reaching now, is the ultimate failure and crisis point for central planning. And hopefully we have some workable solutions coming out of this. We will find workable solutions in the end. The whole question is, how much pain do we have to go through to get there? But I think there's always a message of hope for people to keep plugging away, and that we will find our way through this. The question is, the bumps on the road to get there. But there is hope, and there is knowledge of how to get through this. And all is not lost at this point for certain.
And I think the practical implications of all of that you just said and what we've talked about is for people to keep their own balance sheets in order, avoid debt, and exchange some of that pretend money into the real thing, gold and silver. So anything else this week, David, you'd like to add before we conclude our discussion?
No, I think that was kind of a summary there that I just said. Just looking at the numbers, we've got very, very large imbalance in London, and I think those numbers are really pointing to default, and the question is when. So people need to get themselves in order and prepared for this, and we'll see where it goes as it goes along.
Very good, David. Well, thank you again, and we'll look to do it again next week. Thank you.
Thanks for your time, Jay.